Hello, everybody. So today I want to cover Toast. So if you're not in the USA, you may not know what Toast is. But if you're in the US and you ever go out, you might have noticed over the past 2 to 3 years more and more restaurants using these Toast devices. So what is Toast? Toast is sort of an ERP slash point of sale system that manages the entire restaurant for you. And when I say the entire thing, it really does the entire thing, from managing connection to delivery systems like Uber Eats or DoorDash, to managing your banking, your payment. It manages your website, your marketing, creates gift cards, loyalty programs for you, manages your kitchen, manages your dining room. It really is a holistic approach to running a restaurant, even manages your HR, your payroll, your hiring, and your operations. And as they call themselves, we are the restaurant ERP, or the restaurant POS system, created by restaurant people for restaurant people. And it's really, it's really the kind of thing you're seeing everywhere in the US right now. And I'll have a few more thoughts about that in a second. So what they do, what is the business model, of course, is they start by offering these devices, right? So you have, this is what your server would have, and you can just type your tip in there and pay for your meal. This is a countertop kind of ordering system if you want to order at a booth, for example, or if you want to be placed in a dining room by a server. You also have a self-service version of that terminal where you can, for guest self-service, you have the app, right? You can create a customized app for your restaurant. There's so customized website, customized menus. There's so many things you can do. It's very, very, holistic. It's actually a pretty impressive system, if you ask me. But as you'll see, that's the problem. The problem is the hardware, right? Because you gotta finance the hardware. So I want to point out that this is a company that really puts forward its annual recurring run rate, or its recurring revenue, and it tells us that their current recurring revenue is 1.2 billion, and that's what they communicate on. That's what they want to put forward, this recurring revenue. And actually, if you look at the numbers, so the 55 billion, that's the total US spend on technology by restaurants. So not entirely their market. What is more directly their market as far as making money goes, right? Because the technology spending includes a bunch of hardware where they don't make money on hardware. That's the 15 billion. The 15 billion is their serviceable addressable market. And if you read the footnote, assuming a 55 basis point percentage of the GPV, so the transaction volume, they can assume a potential market of 15 billion. So I don't know how much of that they can capture, but can they capture maybe 10 billion in ARR if you assume that industry keeps growing? Possibly, right? I mean, as this product gets adopted, and we'll see there's a lot of adoption left in this product, right? You still have restaurants who are cash only, are using mostly cash. So this is a business, like I said, I'm somewhat familiar with because of, say, STEM. STEM has the same issue where it's a big hardware component. You got to sell the hardware first, and so your gross margins are going to look very poor at first, and over time, your gross margins are going to grow because the service component, or in their case, the software slash service and transaction component, is going to take over the cost of setting up these systems. But as this company grows, the gross margin is not going to be very good. And in fact, if you look at the gross margin, they have an attractive gross margin based on the recurring stream, as you can see on this chart right here. But the hardware, they lose money, right? And they lose about, 30 million a quarter, 30 to 40 million a quarter on the hardware. So they lose money on the hardware. They don't make any money on the hardware, with the hope that they're going to make much more money with the take rate that they have on the software, on the transaction. And if you're curious, this is kind of how they sell it. So the way they sell it, they could take a 15 cents processing fee plus 3% of the transaction, and that if you go with that, if you go with pay as you go, right, you get the hardware for free. That's an example for a payment terminal, a handheld payment terminal that a server would have. Or they can do the standard, which is they take less, right, 2.49. So they take a smaller fee, but you have to pay for the hardware up front, and you have to pay for a monthly fee of $69. So that's $627 up front. my guess, as I look at these numbers, is that most restaurants do not want to come up with the money up front, especially with the interest rate environment right now. Most restaurants probably go like this, pay as you go, and they may have a problem with collections, right? With what if a restaurant doesn't use the service? I know they have an $89 penalty fee if you don't use the terminal. They have restrictions on using cash. If you want to go with a pay-as-you-go option, you can't really accept cash in the business. There's a bunch of different restrictions that they have to do in the way they charge. So it's all very interesting. But the hardware component is the problem, obviously, because you got to finance that hardware up front most of the time. So. But anyways, there's lots of good things. There's lots of good things. So in the US, they're absolutely everywhere. At least in my part of the US, in Texas, you see that company everywhere, right? And I've asked servers many times what they think of it, and they always, oh, I love it. Oh, this has changed my life. They love the service. I think the restaurant industry loves Toast. There's no denying that. If you look at the quarter-over-quarter growth in restaurants, they grew from 93,000 to 99,000 locations. So that's in terms of location growth, that's 6.5% quarter-over-quarter. If you analyze that, the instant run rate instant increase is 29%. So that's great, and that's the number of locations, right? But then these locations are going to turn on more revenue as they process more transactions. And the question is, so nearing 100,000 locations, how many restaurants are in the US? Well, per this recent article I could find, there's about 1 million, just a tad over 1 million restaurants in the US. 1 million. And by the way, 100,000 of those are chains, so they're really not up for grabs for Toast, because Toast doesn't go after the chains, right? So the TAM maybe 900,000, and then we have to see how many restaurants actually come back from 2021, because 2021 was likely a down year because of the events of 2020 and many restaurants closing. So it's a tough industry. It's somewhat of a troubled industry. A calculation that I'm not going to make, but that one could be tempted to make, but I'm not going to do it. But you could look at 15 billion, right? So 50 billion addressable market. So let's assume they go from 1.2 billion to 10 billion in annual recurring revenue. So let's 10x that. And let's assume they grow the number of locations from 100,000 to 300,000, right? A third of the independent restaurants in the US. Is that far-fetched? Is that possible? I would argue it's possible. This is a calculation that you could be tempted. You could say 10x the transaction volume, 3x the number of location. So you could be tempted of saying that this is a business that could get 10 to 30 times bigger. It's a tempting calculation to make, but like I said, I am not making that calculation. It's way too far out and way too blurry in the distance. But what I will tell you is that this stock seems cheap. If you look at it on an absolute basis, enterprise value over sales is a 1.95. That's pretty cheap, right? If you compare this to, my biggest position is Tesla, so I know the number very well for Tesla. Tesla is almost an 8 on this number. If you look at a lot of elite SaaS companies like a CrowdStrike, for example, no hardware whatsoever. Datadog, CrowdStrike, all of these companies, they're between a 12 and a 15. Right, on EV over sales. So a 2 is very, very cheap, but there's a reason why you pay a 2, and that reason why you pay a 2 is the hardware. You gotta finance that hardware. You have to pay for that hardware up front, which is why, I'm sorry to call it awful, but the gross margin right now is not very good at 22%, and it seems like they've been shy in growing it. They've grown it by about 1.5% a quarter. So, that means a year from now, we're going to be at 28%? Maybe it's a little better. But before we get to margins, that I really like for this type of business, right? For this type of business, I want to see a margin at 50%. This is a transaction business, right? You want to see 50% for a transaction business. You may have 5 7 years to go to get to that gross margin. So it's definitely a long-term play. This is not a short-term play. This is definitely a long-term play. If I put it in my spreadsheet, it's pretty cheap in my spreadsheet. It's not the cheapest, right? It's not the cheapest. If you look at a company in a similar payment space, StoneCo, and you look at the number of StoneCo, you're not even interested in looking at Toast, right? If you look at, say, the numbers of StoneCo, but Toast should trade at a premium because it's a U.S. company. It's operating in the U.S. It's a well understood business, so it should obviously trade at a premium to say the leader of Brazil. But nonetheless, it's a cheap stock in my spreadsheet. This would be considered an okay to a cheap stock, not the cheapest, but pretty cheap. I think the investment decision in a company like Toast has more to do with a qualitative assessment of the business rather than a numbers assessment of the business. To me, it's all about the qualitative assessment. Do you want to be in the restaurant business? Is this a restaurant that interests you and a business that interests you? And if it is a business that interests you, I think I personally believe we're in sort of a recession right now. And so the question is, how much longer is that going to last? Recessions, we know they hurt the going out type of sales, if that makes some sense, right? In recessions, people are likely to stay in and they're less likely to go out. So I think that could be a headwind in the short run. Then we have a secular shift in the restaurant world, which is the impact of Uber Eats and DoorDash and how the younger generation views things like a good time, like going out. It may be that the generations of the future prefer to order a pizza and eat it inside and watch a Netflix show. And what if that becomes a main activity of the future? What if that becomes what people prefer to do? Well, then that could hurt the traditional restaurant business, even if Toast is doing very well. The tradition, it's a business that has headwinds here and there. And then the last headwind that I'll say, which is more of a U.S. headwind, but I see often on Twitter a quote unquote backlash brewing against tipflation, if you've heard of that. And there is no denying that tipflation has a lot to do with these payment terminals. I mean, I don't know how these restaurateurs set up these payment terminals, but how many times do you see the default suggested tip for a walk-up counter? You just pick up a sandwich at a walk-up counter. How often do you see the default suggested tip being 25%? And if you want to leave, say, a 15% tip, you have to go into the settings of the app and you have to say custom tip, and then you have to type it out. Like I think these devices have a big role to play in the whole tipflation backlash that is sort of brewing in the United States. And I've seen it myself. I came to the US, 18% was considered a good tip when I first came to the US. Now it's like 25% is considered a good tip. So again, it all depends on your opinion on this. So there's a few headwinds. However, my final conclusion is the stock is cheap. Am I going to buy it? Probably not right now, because Tesla is still at 230. So it all depends, right? If all of the stocks I love are going back up, then I might be interested in Toast. But for now, probably not. This was not investment advice. This is just entertainment. I hope you were entertained. Please like, please subscribe, and have a wonderful day.